Now we're going to look at a comprehensive example. The information for this example is from your textbook, but was pulled from Yahoo Finance about the Eastman Chemical Company. So first, we're looking at their equity data. Information from their balance sheet about their total debt to equity, current ratio, book value per share, etc. Here we see information about their dividend growth, their annual dividend yield, their 5-year average dividend yield, the payout ratio, and then here we have information about their beta and shares outstanding. And then here is information about their dividends. We have what the current quarter, next quarter, current year, next year, and what analysts project the growth is on dividends for the next 5 years and what it was on the past 5 years. We can see that our beta is 0.98, the value line is 1.2, and Reuters is 1.37. There are 3 different websites, 3 different betas. So we would average those 3 betas together and use an average beta in our formula. The current T-bill rate at the time this information was pulled was 1.98%. Of assumed market risk premium of 7%. So using our cost of equity formula, using the SML formula, we get a cost of equity of 10.38%. We can also use the dividend growth rate to calculate the cost of equity. So we have a growth rate of 6.5%. The last dividend was $2, and our stock price is currently $98.53. So using the DCF formula, we get a rate of 8.77%. So we would average these two together for our cost of equity. Now we have information about their bond data. So they have 11 long-term bond issues that account for most of its long-term debt. So we have to combine these 11 bond issues to get a weighted average. So we have all of this information about the coupon rate, the yield to maturity, the book value, and the current price. To calculate the weighted average cost of debt, we want to take the total percentage of debt represented by each one of these bonds to their total, and we use both market book values and market values for comparison. So we look at this result. So the result is fairly similar. If we do the book value, we get an average of 16%, and if we look at the market value, we get an average of 16%. So the cost of debt is similar when using either the book value or the market values. Their cost of debt is 3.92% on a book value basis and 3.92% on a market value basis. So we have capital structure weights of their market values. What is their total equity? So that's their total outstanding stock times their current stock price, and total dividends, which is the total debt, which is the amount of their bond issue. That gives us a value of $19.32 million. So then when we get the equity is 0.72, and The debt is 0.28 with an assumed tax rate of 21%. We get a weighted average cost of capital of 7.79%. So I want to go back, and we're missing a row. Sorry about this. We're missing a row on this. If we added together our book values and our market values, that is where the 3.92 comes from. So if we add these together, these averages, this is where the 3.92 comes from, if there was any confusion about that. So remember that the firm's weighted average cost of capital reflects the risk of an average project undertaken by the firm. So that's our average risk. Any projects that are similar to our current operations should use our weighted average cost of capital to as a discount rate. However, if our firm is created from different divisions that have multiple or that we have different types of things. So say we have one division that's hotels and one division that is restaurants, they are going to have different risks. So then we should adjust the company's weighted average cost of capital to reflect the appropriate risk and capital structure of the division instead of looking at the entire company as a whole. If we're using the WACC for all projects, so we can see this, what would happen if we use the WACC for all projects regardless of risk? So we have project A and project B. We have internal rate of return, and we have the beta of the project. Well, we know that project A is less risky than project B based on their project beta. If we use the weighted average cost of capital of 15%, we would reject project A for having an internal rate of return that was less than our weighted average cost of capital. So assuming that our rate is. However, we can, a project's rate of return is calculated using the SML and the project's beta. So if we adjust for risk changes, then our decisions change. In that case, we would accept project A and we would reject project B. So if we looked at a required return that had been adjusted using our beta, we get a different decision. We can look at this example in using the security market line or the SML and the weighted average cost of capital, or our WACC. So if we have a WACC of 15% and our security market line is based on a risk-free rate of 7%, we could have a tendency toward incorrectly accepting risky projects and incorrectly rejecting less risky projects. So even though those internal rates of return fall under our weighted average cost of capital, if they're less risky projects, we could still have positive returns on them. So we need to adjust our weighted average cost of capital for risk. One way is called the pure play approach. And in the pure play approach, instead of our weighted average cost of capital, we find one or more companies that specialize in the product or service being considered. So think about if the capital budgeting project that we were considering was a new product launch, and it was a product that we had never taken on before, or a service that we had never taken on before. In that case, the WACC doesn't work because it's not our current operations. So we would want to find companies that are already doing that and take an average of the betas for that company. Then we would use the beta along with the capital asset pricing model to find the appropriate return for a project of that risk. How it can be difficult to find pure play companies, however, because if we're launching something that's never been out on the market before, there aren't already companies for us to compare to. Another way is the subjective approach. So we would consider the project's risk relative to the firm overall. If the project is riskier than what our current risk is, we would use a discount rate greater than our weighted average cost of capital. If the project is less risky than what our firm currently does, we would use a discount rate less than the weighted average cost of capital. So in this example, we have different kinds of risk and what different kinds of discount rates we would use. So for example, if it's a very low risk, we would take our weighted average cost of capital -8 to find the appropriate discount rate. Low risk, same risk as the firm, then the weighted average cost of capital and the discount rate are the exact same. And if we have high risk or very high risk, we should use higher discount rates than our current weighted average cost of capital. That is the end of chapter 12.